What is a trading edge and how do you know you have one? Most traders, they think they have an edge, but really they don't. We've tested hundreds of them. It's exactly what separates real edge from expensive gambling. How's it going? Glenn here from HTA. I usually trade late afternoon into the nighttime in Hawaii while grinding at 3 to 4 a.m. trading the New York session. Today we run Hawaii Trading Academy, and together we're breaking down what an edge actually is. A big percentage of traders don't have one. And in this video, I'm going to show you how to test if yours is real. We're going to give you the framework. Here's a brutal truth. Most traders measure their success by win rate, but win rate's only a piece of the pie. An edge isn't about being right most of the time. It's about what you make when you are right compared to what you lose when you're wrong. We call this expectancy or positive expectancy. The formula is super simple. You take the win percentage, multiply your average win, less your losing percentage, multiply your average loss, and that equals your edge or your expected value. Let's say you win 50% of your trades and your average trade is 500 bucks. And then you have your average losses at 300 bucks. Your expectancy is 500 times 0.5 minus 300 times 0.5, and that'll equal to about $100 per trade. That's your edge. You're expecting over the long term that your stats, your trading system, however you may trade, is expected to generate $100 on average as you go into your trades. That's what you make every time the system triggers. Most traders, their expectancy is negative, even though they have these higher win rates. If your average losses are way larger than your average wins, just do the simple math, folks. The average retail trader loses money because they're running a negative expectancy system. Why? Because emotions built the system, not math. You trade breakouts because they feel like they should work. You hold winners too long, you cut losers. You hold on to losers too long and you're cutting winners too fast. You widen your stops after bad trades. You chase after missing an entry. None of that edge, none of that is an edge. It's just a reaction. A real edge requires a rule-based system that repeats, and risk to reward ratio that benefits, a risk to reward ratio that awards risk taking, and a win rate that produces positive expectancy. Most traders have 0 out of 3. That's just gambling. Let's go dive into a trading strategy that was a back testing to give you a bit of visuals on expectancy. Okay, let's look at this top left area here. We have the back test summary. I was testing NQ. This is just buying breakouts during London session. That's the time I usually trade. And that's going to be around 9 to 10 p.m. Hawaii Standard Time. So if you look, I did a test period between May 2019 to 2025. This had a 2.54 RR, risk to reward. My strike rate was very low, 29%. Okay. We're doing simple math, right? I'm just driving that point. This system has a positive expectancy of $19 per trade. Okay. And this takes about 17 trades per month. If we mix it up, right, what we like to do here is we go a little bit deeper in the just general back test. We take it up a notch and use the Monte Carlo simulation. And so what this provided is it randomizes the trade outcomes, and it turned out the risk to reward ends up being 2.63, same trades a month. Average profit is staying the same compared to the original back test. Average loss is somewhere, it's actually less than the initial back test. But what I wanted to show you is that the winning percentage dipped down 3% to 26% from 29, right? We were at an expectancy of 19 bucks per trade. Now, because of we're down 3% in strike rate or winning rate, that brings the expectancy down almost 30 bucks. Okay. Because we're plus 19, almost 20 bucks. And now we are negative $9 expectancy, right? And the sharp shows, Sortino shows, and that's what we kind of wanted to drive forward. Yeah, this thing looks perfect on paper as if I were to trade this system perfectly. But if you put in a Monte Carlo simulation, just to give you an idea how this particular system could perform going forward or in the live markets, here's worst case scenario at the moment, and so that's what an expectancy will look like going forward when you're developing your system. Now, based on these numbers, I get to a conclusion or a few questions, a fork in the road essentially. Do I give this system a green light or do I not give it a green or give it a red light where, okay, I'm not going to take this to the live markets. I'm not even going to bother trading. Oh, but you wasted a lot of time back testing. Yeah, I did that because it's cheaper to do the back testing and the work than to actually take this negative expectancy, go trade and lose actual money. And so I rather go ahead back to the drawing board and try to fix this up or just toss this strategy in the trash. Just the numbers don't lie, folks. So the hard truth about Edge is not a get rich quick system. You're going to see a lot of people on social media saying, "Hey, this strategy has a 90% win rate. I made $1 million in one day. Follow me." So, but you got to think about that, right? You got to take it with a grain of salt. All those claims online, you have to trust and verify. Okay, what we want to give you was the framework of finding your expectancy for your current trading system. It's a small mathematical edge or advantage that compounds over time. Warren Buffett, king of compounding. You Even though when I was going showing my previous um, system, it had a $19 expectancy. But imagine if you just stack that thing up and you just compound it over time, what kind of returns would it give you? Okay. If you had, going back to our original, um, going back to our original example of having $100 expectancy per trade, just doing basic system. Imagine you have 200 trades at $100. That's 20K in the bank, right? And if that edge scales, it goes up. It can be more, right? But you have to, that's the challenge with trading. You have to stick by your rules, because if you don't, you're going to blow it up and in a drawdown. That's why most edges never work. That's just one pillar of your trading system is your positive expectancy. Figuring that out, verifying it, putting it through the stress test. The other part is having the trader actually stick to the rules. Okay. And that'll be another video that we can put out for you guys. If you want an edge that actually works, we got some free resources. We got a tested edge on our website at hawaiitrading.com called the snapback strategy, where we give you a free back test. We back tested about over 2,000 trades over many different instruments, futures on different time frames as well. And so we want to give you that. Click the link below and you guys can download it for free there. You can see the full breakdown of that strategy on the whole entry system, the stop loss, the managing of the trade. Thank you for watching our video on figuring out your real edge. Subscribe for more.